an author and a trader with over 20 years of market experience and the most viral trading educational video on earth.
If you don't lose weight, it's easy to blame the fitness trainer, but it really is you. You just haven't done the work. The people that kind of say that system must be better, you've got nothing to go on other than the fact that someone on Instagram is telling you should be doubling your account every week. So now you're putting yourself down believing your system's crap.
Jason Greystone reveals not only his investment thesis from his book, but reveals how to connect trading to financial freedom.
Bitcoin, for instance, is doing 50% a year. Stocks doing 15% per year or 20% per year. Doesn't mean you're going to earn that. The way that you allocate your capital should be directly correlated to your knowledge on each of the things. If you're staying up at night checking your phone, you've got too much money in that thing. So the key is to... You can't just pick a strategy off the shelf and trade it into the sunset and it's going to work forever. It's about taking it and then seeing where I'm leaving money on the table, where I've made mistakes. Am I in trades that I should have been in? Am I not in trades that I shouldn't have been in? As long as you're doing that, you're going to maintain a level of profit because you're on top of it.
Because we have your book, which is about to come out. It's around financial freedom. And it seems to me investing is one of the strongest routes towards it. What else would you say is arms of building financial freedom? And more importantly, why it is so important in this day and age?
For me, I've learned.
Ladies and gents, welcome back to another episode. This might be the most spontaneous episode ever. Jason and I, we just met like an hour ago and here we are in the studio. Thank you very much on your last day in town to make this happen.
Such a pleasure. Thanks.
So usually I'm a little bit more prepared because I'll know the guest prior, but this has come on a last minute. So we're going to explore your life and your trading career together. But what strikes me is you started your journey 20 years ago or 20 plus years ago.
Yeah.
And you've probably seen the rise and fall of many a guru. You've seen the CFD space develop, the prop firm space develop, and now becoming an author. It's a lot has happened in your career, so there's so much to touch on. But I want to start off with your strategy. You mentioned is almost a timeless approach. You haven't had to pivot or change too much, which too many would. I see comments all the time of panic of, I'm learning this strategy, but what if it changes in 2 years and I have to relearn it again? It's a common fear that a lot of traders have. What has it been like in your experience in navigating many economic cycles and the markets going up and down?
Yeah, do you know what? Whenever I hear, for starters, every successful trader that I've ever met personally, when I ask them what they trade, they tell me about strategies that they've learned and the first strategy they learned, and then they jump to something else and they went to something else and they end up going back to the first strategy and making that profitable. Mm-hmm. And the reason they picked the first strategy in the first place is because it resonated with them most and it suited them as something clicked, right? So for me, I've learned lots about the markets over the years. I've learned lots of different strategies. I've seen it all. I really have. And what I learned was you can't just pick a strategy off the shelf and trade it into the sunset and it's going to work forever. But it's about then taking it and then optimize it, keeping on top of it, right? So I only trade strategies that, first of all, I've tested and verified to be profitable in historic data. And then once I'm trading it, my journaling then becomes my testing. So I'm constantly journaling, constantly refining, constantly reviewing, constantly doing quarterly reviews and 6-month reviews and annually reviews and seeing where I'm leaving money on the table, where I've made mistakes. Am I in trades that I should have been in all the time? And am I not in trades that I shouldn't have been in? And am I making zero errors, technically and mentally? And as long as you're doing that, you're going to maintain a level of profit because you're on top of it. If you just trade it and then suddenly it's not profitable anymore and you haven't been tracking all of that data, you don't know why you're not profitable anymore. And now you have to go back to square one and start again. And I think the only people that say that they're worried that it's not going to be profitable anymore are people who are not journaling their trades and not optimizing as they go. It's like a business, right? You don't just your numbers in and out. You track the leads and the sales and and you tweak what's not working and what is working, and you end up staying on top of it and making it profitable. So trading's no different, really. I don't really understand when people say that. It doesn't make sense to me.
Something I find pretty interesting is there's a lot of words that are thrown into the mix with this idea. Number one is intuition, where intuition is arguably something real, but someone with 2 weeks of market experience probably doesn't have intuition. So let's say somebody's in a situation where they had an edge that was working. They maybe got a few payouts, let's say, and now they've just hit a losing period and it's all going wrong. What is the difference between my intuition tells me I need to change my strategy versus this is a losing streak, this is factored in, continue trading the plan? how would you know when to pivot when you do review your data and it is negative, let's say?
Yeah, so for me personally, I have a risk tolerance and a maximum drawdown limit, and historically I know when that's going to be jeopardized, when it's going to be violated. I know my maximum loss monetary figure, I know my maximum loss in percentage, I know how long my average drawdown goes through historically. So if I get close to that, then the alarm bells can start to ring, and I can say, well, actually, I best tweak this. But unless it gets anywhere near that, I'm not worried. I'm just trading the plan.
And this is on a quarterly basis. You'll make decisions.
I do a mini review on a quarterly basis, but the major review is on an annual basis. So I'm looking for like profits over 12 months. Like I'm at a place where I'm really not worried if I don't make a profit for a month. Like that's where I'm at in my trading right now. It's very much long term. It's very much swing trading. It's very much profit over time. And I don't worry if in summer, for instance, I have a particularly quiet period, and I've just learnt that that's the way it is. Back in the day when I hadn't had as much experience in the market, I might have got a bit worried or concerned and thought, but now I've got that time in the market, I can go, it's been like that for 5 years, or it's been like that for 7 years, and it doesn't mean that it has to stay like that. You can develop a complementary strategy that is good in the summer, right? And you can add that to the arsenal, and you can start to capitalize on opportunities there on that quiet spell. But for me, I'm just in a place in my life where I'm happy with what I'm doing, and I'm incrementally increasing my strike rate over the years. I went from a 55%, I'm at about 62% right now. Increasing my reward to risk profile, I went from a 1.5%, I'm average 1.8% now. It's not major, but it keeps up with my mindset. It keeps up with. I wouldn't want to go from 1.5 to 155% trader to 100% trader. I just wouldn't be able to. I just wouldn't.
I think also this pendulum approach breeds no longevity, because it's all short term. It's kind of, let's say, random, momentary highs. I want to pin this word longevity, because time in the market isn't necessarily an indicator of success. Because I've also come across traders who have been trading for 5 to 10 years and lost money for 5 to 10 years, and it's rather bizarre, because you would, in any other field in life, if you commit something, time and effort and resources for 5 years, usually there is a positive outcome. The market is not the same. So what do you believe is the key to longevity in the market, and also making your time worthwhile, as opposed to just 5 years wasted on left, right and center?
It's just not knowing your numbers, not testing the system, and not journaling your system. That's literally it, because they're just... If you don't lose weight, it's easy to blame the fitness trainer, right? But really it's you. You just haven't done the work. Like, you just... eat less than you burn, and walk and lift some weights, right? And the people that kind of say, oh, well, that system must be better, are the people that just jump again and again and again. And what you do by doing that is lose consistency. So the moment you lose consistency, you're pissing in the wind. You've got no, where do you go from there? It's just going round and round in circles. And like you, I've met not millions, but I've met, it seems like millions of people that just go round in circles.
Yes.
And I say to them, well, what's the positive expectancy on the system? And they're like, well, I don't know. Why don't you know? Well, I haven't tested it.
That's where you should begin. Yes.
That's where you should begin, because you need a reference point to try and approximate. And if you don't have that reference point, you've got nothing to go on other than the fact that someone on Instagram is telling you should be doubling your account every week. So now you're putting yourself down, believing your system's crap. So now you've got to go and find another system. It must be the system. Yep. But it's, as I said before, the best traders I've ever met have gone back to the first system they learned and made that profitable. And that's the key.
In your career, a couple of decades, you've seen not only the industry change, you've also seen the rise and fall of people and strategies. And not to put names out there, but there is certain trading approaches that are very lower time frame, M1, high risk reward. Then you've got the people that are super swing trading. There's many buzzwords and strategies that go around. Just because that's probably the cause of what you're saying, of people bouncing around and not knowing what's going on, because they're just pulled from different directions. Yeah. Exactly. So what would you say is a dose of reality of what is a realistic, achievable, consistent win rate, risk reward, trade frequency, rate of return, what is achievable growth in terms of percentage gain per month, per year, just so someone knows or can see, okay, if someone is telling me this, ground yourself here is more reasonable. Where would you
Okay.
say that is?
So the traders that I've met, I've met some anomalies that do say 6% a week, right? Which in my opinion is an anomaly. Between 2 and 4% per month, 4% being impeccable, 2% being very good. And I've worked with very, very reputable prop firms in Midtown Manhattan where I've spent 2 weeks on their prop desk with teams of people, and that has been the case there as well.
We're talking real prop firms, not the
Real prop firms, real prop firms,
yes.
not wolf in sheep's clothing.
I want to take a moment from the episode to remind you of Alpha Capital, a long-term sponsor of the show, a leading prop firm in the entire industry, and in the last year they did over $50 million in payouts. That's why they are a top-ranked prop firm that's been around for years and is not going anywhere. And with the multiple step plans they have and the multiple packages that they have, there is going to be something catered specifically to your needs at the most competitive pricing. And because we have a long-term relationship with them, we are able to bring you a massive discount of 20% off all evaluations. So click the link in the description or use the code TOT to get 20% off all your funded accounts. Working with the best prop firm in the industry, Alpha Capital.
Have you found there are certain needle movers that are more worthwhile to pull? What I mean by this is someone maybe is struggling in their strategy. So they'll be like, okay, I'm not profitable right now, but things are going okay. Let me focus on risk to reward. Let me focus on win rate. Trying to squeeze the juice out of one thing or another. Or maybe it's profit taking systems, maybe it's risk management. Do you think it's something that is the 80-20 to focus on, or it's a holistic approach?
I think when it comes to picking a strategy that suits you as a trader, it is those three. It's like win rate. Do you like being right more than you're wrong, or wrong more than you're right? You're going to have a personality defect around that somewhere, right? Or do you like a big reward to risk profile? So you're happy being wrong more than you're right because you're getting a 10 to 1, right? But bear in mind, you're going to have a lot less trades doing that. You're going to be, you're not going to have as many opportunities. And then opportunities is the third one that I think people struggle with, because people have climatized this idea that you clock in, clock out, and you exchange time for money. So when you go into trading, you feel like you should be doing more. So there is a comfort level to how many opportunities you get. And sometimes having more opportunities can make you feel more at ease that you're doing something.
Because you feel productive.
You feel productive,
Yes.
right? But it's not correlated to trading at all. You can earn as much trading for 20 minutes a day as you can spending all day at your charts, theoretically, depending on what system you've got. So those are the kind of components that suit the personality of the trader. And then after that, it's just really about strategy. So consistency is the key. When can you be in front of the charts that will allow you to be consistent and not break consistency? That's a key. Why pick a strategy that plays out in the London to New York crossover if you're doing a school run at that time, or you're doing some meeting at that time? Because a lot of retail traders are doing this part time, or trying to fit it into their life or around their life. So unless you're doing it full time, you need to bear in mind the consistency aspect as well. And then after that, it's just optimizing for better reward to risk profile, less risk manager, money management strategy. I know people who have very good trading systems, but barely break even because of a poor money management strategy. I know traders who have a average strategy that make lots of money because of a good money management strategy. So the money management is kind of the magic around how the real money's made in trading, which not many people talk about.
If you can elaborate money management, would that go into risk? What are you defining as
Yeah, so risk management is how much you're risking of your entire portfolio on any one trade. So for instance, a lot of people say, 1% a trade, right? What that doesn't take into consideration is how many trades you're in at one time. So if you take 10 trades, you've now got 10% of your exposure, right? So money management is how you apply your capital to that exposure. So it's similar but two different things. But understanding that is crucial to
Do you believe that certain trades warrant greater risk if you have more confidence, or it has a higher win rate, and let's say a B+ setup that is not your bread and butter but it's still worthwhile, 0.5% risk, or should risk be standardized on all trades?
No, yeah. So I have a dynamic way of approaching the markets, being that depending on the quality of the setup, you can become more aggressive on your entry, more aggressive on your risk reward profile, more aggressive on your position size, more aggressive on your risk, more aggressive on your target taking. So depending on the quality of the setup, I will either have a different entry, which is more aggressive or less aggressive. I will have a tighter risk, tighter stop loss, or a wider stop loss for more breathing room. I'll have a bigger target. I'll shoot for a bigger run rather than a smaller run, or I'll split the position in two. Or I will increase my position size. So I'll have a higher overall capital exposure to that one trade, depending on the quality of the setup. And I think that served me really well, but it's a concept that I don't think many traders open their eyes to. They're so closed and fixed on, I have to trade this way, and rules. But actually, if you can dynamically adjust your approach to every trade, but don't confuse that with not having rules. Everything has to be rule based, because that keeps the consistency. But as long as you've got those rules there and you've tested those rules, then you can really become this kind of, you can get more opportunities, you can be right a lot more, and you can make more money.
If you can describe to me the pillars of your A+ setup in terms of what are you looking for in the technicals?
So support and resistance is crucial. I'm a technical trader, right? So quantitative analysis would be number of tests of major support or resistance zones, even handle numbers, things like how previous structure was tested. So for instance, some support levels or some resistance levels are tested on support more than resistance. So there might be a price point that is historically, every time it's tested as support, it tests it 3 times, but historically on the way up, it's resistance 10 times. And that will be a more aggressive short trade than it will an aggressive long trade. And then for entries, I'll look for some kind of confluence using support and resistance. I use a MACD indicator for reversals. I use exponential moving averages for convergence, or for trend, convergence, divergence on the MACD. And depending if we've got that confluence, I'll either use double tops or 3-bar reversals, or literally a candlestick formation of some kind, depending on how many times structure's been tested in the past. And then discretionary price levels. So I've got a list of my own discretionary price levels that I've just noted down over the years and years of saying, well, last time, I waited for a double top here. Actually, I missed out on that trade 10 times out of 20 because I waited for that double top. Had I taken a 3-bar reversal instead, I would have got in. So that's years of discretion. Like, that's years of taking notes, basically.
When I in my own journey, let's say, of exploring these kind of concepts, support and resistance and so forth, I often found myself getting wicked out, or maybe not even wicked out. Let's say I'm seeing a resistance level. I might be thinking break, test, continuation, looking to buy, whereas it does the break, test, and then continues lower. So I got the direction wrong. Therefore, you're kind of manipulated on if you're shorting it, you got stop loss hunt, and if you're looking to buy it, well, it went down. How do you navigate these key points in the market where there is a lot of activity, resistance, support, a lot of orders in the market? How do you navigate between what is a real rejection versus we're just inviting in orders to then manipulate and then the real move, which a lot of people do end up getting caught on? How do you protect yourself from that?
For me, it's a confirmation bias of various filters. So I look at the market condition, making sure that I'm taking bullish setups or long setups in a prevailing trend that is bullish, and I'll use a higher time frame. So I use multi-time frame analysis to look for prevailing trends. On the higher time frame, I'll look for the setup on the trading time frame, and again, that will be making sure that we are in the right phase of the market. So if I'm looking for a long setup, we'll have to be in a pullback or a retracement. If we're looking for a counter setup, we'll have to be in a run phase. But I'm primarily a trend continuation trader. I only take certain structure-based setups at major support and resistance levels.
What time frames are you hanging out on when you do your top
daily, 4-hour, and hourly.
And hourly, I guess, is for entries.
Yeah, yeah, and trade management. So
Okay.
the setup's on the 4 hour, and then the entries are on the hourly, and then I'll manage. Sometimes I do. I have a rule where I can trail stops on the hourly as well, just because it's nicer. I also trade the range bars.
Okay.
So the 8 range bars as well. So that's a completely different animal.
How does it sound to have a chance to win $1 million in evaluations from trusted leading prop firms? And the best part is, to enter is absolutely free, and we're doing it every single week. This wonderful opportunity of $1 million in evaluations every single week is brought to you by a partner and sponsor of the show, Prop Firm Match. Now, Prop Firm Matches are all-in-one comparison websites for all trusted prop firms, with verified reviews from actual customers, both positive and negative, and a full selection of filters that you can pick from based on if you're a swing trader or a scalper, based on if you want to trade news or not. Whatever option you want, Prop Firm Match has got you covered. And the best part is, because they are the largest comparison website platform in the industry, they're able to negotiate and bring to you the best discount codes available on the market. So all you have to do is sign up with the link in the description, make an account for free, and there is a chance you can win $1 million in evaluations every single week.
So I remember off camera we were discussing your career, and you started off as an investor before you transitioned into trading, or let's say day trading or swing trading, as it seems you are. Let's first of all define the differences. What made you do it that way around? Because typically people don't have money, they'll go to the markets to try and get some money and then eventually look to invest that money. Is that a realistic route?
I don't think from experience tells me that that's statistically not successful, purely because I don't think you should grow your money at a rate that your mindset can keep up with. So where there's higher volatility and higher risk, usually a higher level of skill is required. And most people go into trading thinking that they're going to make money trading. They've had no experience in the market having their money work for them. They're not great managers of money, you know. So if you're just pulling large sums of capital out of the markets from trading, why would you miraculously all of a sudden become a great manager of money? So I'm a firm believer that you have to earn your right to higher degrees of risk.
Okay.
And you do that by getting your feet wet, basically, right? So, you know, if you imagine speculation being the tip of the pyramid, trading being the tip of this pyramid, and the bottom, I suppose, being a high interest account, you know, where
you, so high interest, no
right,
risk at all. Yes,
no risk at all. There are incremental steps along the way that you've then got to earn your right to that level of volatility and speculation. Right now, as you ascend that pyramid, you're going to ascend higher returns, yes, higher levels of risk, higher skill requirement, and you're going to have to be more involved. There's higher leverage. More time required, more, you know, so all these things.
Everything gets harder, basically.
Everything is harder. Right. So it's like you're trying to build an upside down pyramid, and that doesn't usually work well.
It's a very interesting approach, and I think the general belief of a typical new trader, I think most people start in their 20s and they look towards online means to learn. And they often think, okay, well, especially now with the rise of prop firms, it's okay, I can now, with a small amount of money, potentially make a lot of money. Once I have this 100K magic number, then I can put it towards investing. And it's just, as you say, you don't have the maturity to be able to do so. Even if that route is as realistic as it is or isn't, the numbers show otherwise. But it is a very correct approach. When it comes to investing and trying to find maturity in it, especially for someone who is a bit younger, who doesn't have the capital to just deploy hundreds of thousands of dollars, what is a way you can learn from the lower levels of this pyramid without having to take leverage or take a loan or other means? It's just, with the money I have, how can I learn the skill set of investing?
Well, I mean, there's a great quote that says that if you empty your pockets into your mind will fill your pockets, right? If you don't know what to do, the first thing you need to invest in is knowledge. So I get it. If you're young, you want the quickest path to riches or to the best return. What I've found personally is the higher return that you can get isn't correlated to whether or not you're going to get it. So I was having a conversation yesterday and someone said, well, what do you think about stocks over Bitcoin or crypto, right? And I said, well, yeah, Bitcoin, for instance, is doing 50% a year, right? and let's just say a stock's doing 15% per year or 20% per year, doesn't mean you're going to earn that, right? Because you don't know about Bitcoin, and you might not know about the stock, but the way that you allocate your capital should be directly correlated to your knowledge on each of the things. Because if you're staying up at night checking your phone, or something's keeping you up at night or distracting you whilst you're in a meeting, you shouldn't have that. You've got too much money in that thing. But you're either over leveraged, or you're putting money in you can't afford to lose, or you don't understand it. And that's really the only reason that you're affected emotionally by that thing. And the moment you're affected emotionally, the moment you're going to jeopardize the whole strategy. That's what I've found. I've found that 100% of the time. I've never found that not to be true. So the key is to, if you don't want FOMO, to put money into something that you don't need to understand as much. Maybe an index fund, or maybe a large cap stock that you believe in, right? And then put an allocation of 10% into your trading account, right? Now, I appreciate that's not going to be a lot of money for a lot of young guys. And this is the problem we're facing with social media, where they tell you that, you drive a Lamborghini and all that kind of stuff. But the monetary return is just not going to be worth it for most people, because they actually don't want to learn to trade. It's not exciting to them. And I recommend most people don't trade. I recommend it's not for most people. What we've found is the people that come out statistically the best, with the best results, are military, IT, engineers, people who are very process oriented and just know that if I do X, Y, and Z, I'll get A at the end of it, and that's really it. And kids don't think like that.
It's interesting. I have a friend of mine who's done very well now, but in the beginning, in his first year, he was taking the prop firm route, and it was at the time when prop firms you needed 10% in a month to pass, so already a huge challenge, and he failed back to back for like a whole year, and he was very frustrated with himself. And we said, okay, how was month 1, 2, 3? And he listed it out. It was like +2,
Incredible.
+4, +1. It's like your first year in trading, you netted, let's say 20-30% for the year. You just didn't pass the challenge, but you gotta pat yourself on the back. And he was actually a boxer. And it was very interesting because his just the phrases he would say to me of like, I'm not going to go and take a trade because I wouldn't go into the ring and fight if I haven't done my training. So I'm not going to backtest first before I enter the market. These kind of mindsets that are ingrained in someone that is a military person or a boxer, let's say, it's in their DNA to know process before being in the limelight or in war or something. You got to do your reps prior. With regard to this investing approach, so regretfully, I didn't start as early as I should have. Only recently, where I've gone rather heavy. But my approach has been, I don't know investing. It's not my area of expertise. So I've just kind of taken an approach of buy the big stocks, the names I'm familiar with. Right now with the tariffs, there was a nice retracement, let's say. So it became an opportunity to buy things that are, they have value for a long time. Yeah. And then just indexes, because I'm not striking for 100% a year, but 10% a year is worthwhile with compound interest, and just dollar cost average. Do you think someone approaching investing would be the best approaches like this, just dollar cost average and buy big names? Or is there edges to carve out within investing itself?
Yeah, I'll give you an edge for like an advanced dollar cost averaging. So what I like to do is approximate the mean growth of the market, right? So I take a 50-year view on the market.
Okay.
And I look at the 50-year mean growth of the market.
Like a 50-year moving average.
It's the midpoint between the two extremes on average across the growth of the market, right? So you might have heard of mean reversion and things like that.
So basically, if you're above that versus below that, is a buy-sell opportunity.
Exactly, right? So dollar cost averaging is a great strategy where you are regularly depositing you're buying the market monthly, right? Buy your market like groceries. And every month you're putting a certain deposit into the market. Except if you track the mean growth of the market over a 50-year period, what you'll see is when you go 10% over that mean, it means that we are becoming
overbought, I guess.
Yeah, this could overpriced. The value's not there. So what you can do is strip back your regular deposits a little bit, say by 25%, and then If we continue up and go 20% above the mean growth of the market, you could strip it back another 25%. So you're only putting half in. And what you do is you save that cash for the crash. And you're saving this little kitty up. And then as soon as we drop 10% below the mean, you basically divide what you've saved and you put that into your regular deposits over about a 6-month period is usually optimal. And what that will mean is by the time we come out of that recession or out of that crash, you'll be in profit rather than back to square one.
Yes.
As financial advisors will tell you, just ride it out.
It's very interesting because as a result of that, you're bringing your average price down, weighted for how much you're investing.
Weighted averages are so important.
Yes, it makes a lot of sense. I was just back in the UK last week, and I was with my brother, and we were just through ChatGPT. We were just brainstorming ideas of investing, and one thing was dollar cost average. I'm actually doing it on a weekly basis, and he asked me, "What day of the week do you invest?" Because I was trying to encourage him to do the same because he's 10 years younger than me. I was like, "You got a head start if you just do it now." And ChatGPT, I was like, "What is the best day to dollar cost average for the last 10 years? Which day of the week was best on this on Tesla on the S&P?" And it just pulls the lowest day of the week over time. I was like, okay, that's my dollar cost average.
Amazing.
Day. I was like, that was a wicked thing. One thing that I really wanted him to realize, because he had this comment of, well, I don't have that much money. I don't have any money right now. I'm a student. What's the point of me investing a tenner or £20 or whatever? So I told him, okay, when you get into a job, £100 a week is a lot, but it's also not a crazy amount. £100 a week, if you do that from now, which he's in his early 20s, to the age of 60, you would have a portfolio worth 1.6 million. I was like, there's no excuse in this day and age to not be a millionaire, because £100 a week or £50 a week can actually compound to that point just by average growth. Like we're not trying to beat the market here. So then when you come to look at trading, you're like, okay, well, you have to now think, I'm going to outperform that, which is why I'm going to now even bother to learn trading.
Otherwise, it's not worth it.
Otherwise, because people
it's a bloody headache.
Because people come into the markets like, I don't have money, I want to make money.
Yeah.
But and they've thought, oh, well, it must be trading, or maybe just pull it back and say, oh, it could just be investing. What I have, and at least that is stable, and that can bring me something whilst I learn, and then I go from there. When did you start investing yourself?
22 years old. Yeah.
Very young. And what was your approach back then, and what is it like now?
So my approach was very much, I started just buying index funds, and then I had this idea that I was going to replace my income from my job in 20 years. And that was on the concept of investing 10% of my income at a 10% return per year. And then I became obsessed with reducing that time down. So it was like, okay, well, I'll increase my savings every 3 months, and then I will look for better yields. So I started looking at ETFs and more kind of less automated approaches to funds and things like that. And then I started to learn stocks. So I learned how to value invest, how to do qualitative and quantitative analysis by reading financial statements, understanding balance sheets and cash flow statements and income statements. And then I'd use stock screeners, and I would kind of basically try and increase the return from 10% to 15%, investing in stocks, the overall percentage return. And then I just kept going and going and going. So it was like earning my rights to higher degrees of risk. So it was like, okay, well, I'll pick a smaller stock now. And then I will look at I've done startups and everything. I've done angel investing and all sorts, but real estate investment trusts. So more kind of niche pools of companies. And I've done everything. So it's basically just trying to increase that overall percentage on my entire portfolio, reduce the drawdown on that entire portfolio, and just keep growing it. And trading was the last piece in the puzzle for me.
Super interesting, but with the pyramid analogy you gave, it makes so much sense. When it comes to a well-diversified or healthy portfolio, what would you say is an ordinary split between markets and you have your bonds, you have your ETFs, you have your property or property indexes. There's many things you could trade in, and then you add in gold, commodities. There's so many things to invest in. What is a healthy way where you're not overexposed to one, but also not underexposed to opportunities?
Yeah, for me, it all comes down to your knowledge in each of the sectors. So how much do you know about each thing? Because I feel like there was one point where I had 40% of my net worth in my trading account, and I didn't have that much in there for that long. But that means that I'm really confident in trading, right?
What would you say is an appropriate balance between trading accounts versus portfolio?
statistically, for what most, like if we're talking about the success rate in traders, 5 to 10% of your net worth in trading, right?
Yes.
Otherwise you just won't handle it. But people think that they can throw their 100% of their net worth into a trading account. Good luck, and I hope you do well. But in fact, if you do well, I'll give you all my money and you can just trade that. But realistically, it's a minority portion of their net worth, because when your whole net worth goes down by 10%, you are affected mentally. We can tolerate as humans a positive or negative of 10% fluctuations in volatility in anything, really. Anything outside of that, we start to feel really uncomfortable. So if you're tracking it as your whole net worth and that all goes down 10%, you're gonna struggle. So the way that I allocate is, one, based on knowledge, how comfortable you are and what skills you've got in each of the classes, and then two, what your expectation of that is to go to zero. So if you're going to put something in Bitcoin, expect it to go to zero. If you're going to put something in crypto, expect it to go to zero. If you're putting it in the S&P, expect a 40% decline, right? So the worst case scenario in all of them, and making sure you're okay with that. And if you marry up those two things, you should have a good indication of what you're comfortable putting in each pot. Does that make sense?
Do you believe in this idea of, because investing can be thought of as passive income, because the way you're describing it is very active, it's very research and stay on top of things, and then pulling money out or dollar cost averaging a little bit less, so it becomes a full-time endeavor. Therefore, this passive income idea, do you think it's realistic?
I mean, the passive income is real. If you put all your money into an index fund and it's managed by someone else, you probably that probably takes an hour to do. You can automate it and you'll get paid, but realistically, stock investing takes a bit of time, but there's degrees of passivity. I mean, it takes me to invest. I do my investments every 6 months, right? So every 6 months I'll spend a few days in the markets just doing my stock screening and analysis. And can I recommend a tool? There's a great tool that forecaster.biz. You heard of it?
No, I haven't.
Phenomenal. It does what I used to spend 3 weeks doing in 10 minutes. And it's
and the idea being is finding best buy zones?
It does all of the analysis in terms of seasonality, price correlation right now. It does it'll do Peter Lynch scoring, Warren Buffett scoring, and it collates all that information in the back end. It provides a breakdown of what's happening fundamentally, all of the day. So where you would have to go to like Yahoo Finance or MSN Money and then go to a stock screener and check through, it does all of that. The PE ratios, it's phenomenal. I can't recommend it highly enough. And it's one of those kicker softwares where you think, I just wish I had this years ago. But that is phenomenal. So so you can get a lot of this information on Forecaster. And it's not passive. You still have to understand. I think trading isn't passive either.
Yeah,
people think,
active,
I want to do trading because it's passive income. It's not passive income. I mean, it's passiver if you're swing trading and you're spending half hour a day or an hour a day, and it's very mobile as long as you've got a broadband connection. But it's certainly not passive.
I mean, to be honest, even myself, there is passive things, or passivity, as you said, degree of it. But even this idea of like, I want to have no input and do no work, it's not even something I desire, to be honest. Like, let's say checking your portfolio once every 6 months and making decisions. If that's considered work, then that's lucky, because it's not so strenuous as other forms of income. The reason I spent a bit of time in this episode on investing, which we usually don't, is because we have your book, which is about to come out. And the idea here is, well, you can describe it best, but it's around financial freedom. Yeah. And it seems to me investing is probably one of the strongest routes towards it. What else would you say is arms of building financial freedom? And more importantly, why it is so important in this day and age?
Yeah, so I mean, you just mentioned passivity, right? So if someone's goal is to have passive income, you're probably never ever going to have passive income, because you're going into something as an escape, right? For me, I was an absolute geek. I was obsessed with spreadsheets and data, and I just sit and look at puzzles and charts, and that's been me since I left school, right? And as a byproduct of doing that, I've made some money. And that's really it. Like I'm in love with this whole puzzle piece. Same with investing. Same with, Rubik's Cube. You're just kind of fascinated by something and you'll solve the problem. But ultimately, what people really want is freedom. They just want, they want to wake up and do what they want with who they want, whenever they want, right? The problem is most people don't know what they want. That's the first problem. As we were speaking off camera before, people get pushed into the idea of what they should and shouldn't do, and they think they're going to end up here, but they've ended up here. And the reason they're here and not here is because they've taken decisions that are someone else's values or poor advice, or they're chasing some other shiny object, right? And they don't even know who they are. I've met so many people in Dubai who are lost. They've got loads of money. They're born into money. In fact, they're the worst. They're like, I have no idea who I am. I've got no purpose whatsoever. And it's a real pandemic. But ultimately, all we want is freedom, right? So we want to be free in mind, free in movement, and free in money. And the financial element of that is how much time you can buy into the future, how much leveraged income streams allow you to pay for the things that are meaningful to you, which is going to be different for everyone. And then being able to do that from anywhere. And then having a mind that says, this is how I'm going to spend my money. This is who I am. I don't need to chase this goal or that goal. I often say, I have no goals. And I think the goal in life is to have no goals. The goal is to just live a life every day that's like, if I lived today, every day like today, I'd die a very happy person. And I think that's the goal.
There's a guy called Naval Ravikant. I don't know if you're familiar, but someone I consume a lot of his stuff because it's just a lot of wisdom in it. He's a billionaire and a very thoughtful person. And he some things that I learned earlier in my career of like, give yourself a dollar amount of what is my hour worth. And even if you're working a regular job and it's like $30-$40 an hour, put your number way higher. And he said the reason for that is because you also got the ability to say no of things you shouldn't be doing. Yeah. And it's just bringing that self-worth to yourself. But beyond that, what is recently is from a place of luxury, but he goes on to say people like to have a very structured life and a very structured routine, and a very Monday morning is this meeting and then Tuesday is this. And he said, that is great, but if you're in a position where you don't have to do that, you shouldn't, because when you feel like reading a book, I'll read the book. You don't want to read it anymore, you want to pick up another one, you can. You want to go for a walk, you can. This level of freedom. He went on to say people do things of like a meeting to have a moment of serendipity where we sit down, we talk, and hopefully an idea comes about. And he said when you have no structure to your life, everything becomes serendipity because you're following your true curiosity. And he said that's a real flexible and a real way to live life, because you're not now waking up, looking at your emails, and now these emails are commanding your time. And then you got a meeting booked in, that's commanding your time. Yeah. So it's a true freedom of mind, and therefore the ability to explore and therefore grow comes from absolute flexibility. But the undertone is you need your finances in order to be able to express it. Of
course. And what you mentioned earlier about, like, I earned money trading as a byproduct of being fascinated with charts, right? And spreadsheets. I think if you raise we all have income goals, right? And sometimes we might hit those income goals and sometimes we might not, but you'll always hit your standards. So how many people take a pay cut? Not many, right? So you get a pay rise and then that's it. That's your new standard. And then you get a pay rise and that's your new standard. You won't take a cut after that, right? So it's just about increasing your standards of yourself and being the person you admire, and proving to yourself you can do it. And then inevitably you will reach higher degrees of wealth because it's just a byproduct of raising your standards.
So let me describe something to you that I've been feeling lately. I consider myself a very ambitious person, and therefore I put effort in and I put resources in towards my goals. But it now feels like my goals are no longer aspirational or an achievement. They feel like I have to. And therefore when I have achieved certain goals recently, it didn't feel like a triumph. It felt like a relief, or I got it done. Right. And therefore my threshold was no longer the goal equals a sense of achievement. It becomes a minimum standard. So now when you achieve something that is something you put on a pedestal, now you achieve it. For me, it became now the new floor, which is maybe a very flawed it is a flawed mindset, but I can't help but feel like this very often in the last year or so, where I think it's maybe a byproduct of being too ambitious. I don't know. But it is this idea of always wanting more. And then when something is ticked off, it's very quickly on to the next and making this my new minimum standard. Is this something you experienced yourself?
Just yesterday, I was speaking to someone who said, my next goal in the business is to get 50 million. And I said, why? And they said, well, it's just the next round number. And I said, okay, well, to get that, it's going to take a lot of graft. You're going to have to be away from your family, and your wife might get annoyed, and your kids, sacrifice time with them. You've got to put in a lot of work to get to 50 million. Why do you want 50 million? And he's like, well, and it turns out that it's really just to prove his ex wrong, or some boss or some colleague or someone who said he couldn't do it right. And it's sad because he's chasing a goal that isn't his. So he's a slave to someone else's mind. And that's where people don't know themselves. And I think where it's common, like an example like you just gave, I think it's to prove a point. Maybe to a parent, maybe to someone who is, Alex Hormozy, I know I look at that guy. In fact, he messaged me yesterday on Instagram because I hit a nerve where I was like, you will never feel like enough is enough. And he's like, you're right. And it turns out that he's just trying to prove his dad wrong. He's really trying to prove his dad wrong. You can see in some
of his pods where he speaks about his upbringing and his relationship with his dad. Like, that's a big trauma in his life. And it's interesting how these childhood moments can really brew late into adulthood.
Absolutely.
And it becomes your North Star without you realizing.
And you need it if you're going to be successful. What I've found is that's what you need to drive you, right? That mental leverage.
Yeah, they say you're either driven by inspiration or desperation.
Yeah.
And desperation can come in forms of hate, an ex, a break, or whatever it is. But those are the better fuels because they keep you driven for longer. Whereas if it's just inspiration, it's kind of like a motivation. It comes and goes. Whereas if you have something you're running away from, well, you can use that to your
100%.
advantage.
Yeah.
Where I want to take the conversation next is this idea of leverage means you mentioned earlier. And a lot of people might be looking towards, I'm going to university, I'm getting this great degree, which is going to give me a good salary. Maybe later on in my life, I can earn 6 figures with this degree. A path put in front of me, and I did follow that path, 6 years of university to become a dentist. And I quickly realized that the road is not the same anymore than it used to be for my parents' generation, where a good job and a good degree and a good salary would be able to afford me a house and be able to accrue a level of financial freedom. No longer the case anymore with house prices, inflation, cost of living, everything is changed. How do you navigate the world now as a young individual who has a roadmap in front of them of go to school, go to university, get a good job?
First of all, question everything. I mean, that's pretty evident that you need to question advice from people and make sure that it's something that is truly aligned with your values. It's very difficult to do that as a kid because you're impressionable and you're hands out for advice and you're being guided. So I get that, right? But that's a difficult thing to do. But whatever you go into, ask yourself the questions of, how leveraged can this become? So leverage, the term leverage for me means a unit of passivity and mobility. So the more places you can generate that income from, the freer you feel. And the less time it takes you to do that task, the more freer you feel. And that is a scale, right? So it's not like a binary thing where I've got passive income, I've got leveraged income, or I haven't. It's like, well, right now I can do it from London, but how can I do it from 2 cities? How can I do it from 3 cities? And the more close you can do it, the more free you feel. When we had lockdown, we were all locked inside our houses and everyone felt more freer. And the reason they felt more free is because they felt like they could structure their day how they want. They could prioritize their tasks in their time. And there's a study that says people would have happily taken a pay cut and had more free time or continued working at home. And that proves it, right? So you feel freer when you are more mobile. And then passivity is like, I don't know if anyone's read 4 Hour Workweek. Tim Ferriss basically wrote a book called 4 Hour Workweek. The first half of the book is teaching you how he became mobile, how he persuaded his boss to let him work from home, which COVID really solved for everyone. And then the second half of the book was how to make it passive by delegation, automation, systems. And the world we live in today just makes that piece so easy. Whatever your tasks are, which if it's computer-based, I mean, it's pretty much, you can just get an app to do. You can get whatever you're doing on the computer, you can increase passivity drastically, almost nothing. So if you can work on those 2 things and make sure whatever it is you're doing as a vocation is aligned with those 2 things, then you're going to have a level of freedom that you probably won't if you're working in a restaurant or a dentist or
Do you think this idea of time for money, specifically speaking of a job, is something that people should look to get out of as soon as possible? Or is there always a place where it just depends how much your time is worth?
I think there's no time for money correlation in today's world if you're willing to, for instance, become your own personal brand. I mean, this isn't for everyone, but I'm assuming that people watching this podcast are into some level of self-development, right? So it's fair to say that they understand the concept of having a brand, otherwise they wouldn't be watching this podcast. I give an example. You know, you could be a fitness trainer charging £45 an hour, and you're capped by how many hours there are in a day, and you probably don't get a lunch break. And the most you're ever going to make is £450 a day. You could be a fitness trainer who writes a book and gets some incredible results and becomes this speaker and does some thought leading and does a podcast, and all of a sudden the perceived value of that person is going to go sky high, and they don't have to compete on price with a fitness trainer anymore. They now charge 10 times the more for working 10 times less. So if you teach the teachers, that would be my advice. If you're a dentist, teach people how to be dentists. Like that is the leverage, and the platforms we've got today are just open for that.
As a trader, it's very simple. You have to find an edge, and then you have to have a mind so you can follow that edge. But how do you know if you're performing correctly or not? You have to know your data. And TradeZeller is going to show you everything that you need beyond the surface level win rates and performance and equity curve. It's going to show you detailed reports. It's going to be your back testing tool, strategy testing tool, playbooks, notes, and it's going to be a full journal. It makes your journaling easier, faster, and more meaningful. Whereas if you were just documenting it on an Excel spreadsheet or taking screenshots on your iPhone, you wouldn't be able to pull out the data that you need. The correlations that the AI within TradeZeller is pulling out for you. There's so much variety and utility within the software that I think it's essential for any trader. So the link somewhere below is going to take you directly to the TradeZeller website. I'm not getting paid. This is for you. If you want it, if you like it, go ahead and explore it, and probably you'll be using it for years to come.
Yeah, I mean, since when I had my own midlife crisis, let's say at university, where I was like, I've got my
How old
parents,
are you?
I'm only 29, but this is when I was, let's say, 22. I was like, I got to have a conversation with my dad because he's funding me to go through university. And the last thing I want to do is say, hey, Dad, I don't want to do this anymore. So it was a very tough, it was years in the making to finally have that conversation and then get his approval and blessings. But either way, the word, like you were obsessed with certain things, back then I was obsessed with just the word leverage.
Right.
And the way I understood it was like lever. I was like, well, a lever is like, if you want to move big things, if you have the lever in the middle, you got to weigh heavy to then move something heavy. But if you can move that lever in a certain way, it's like Archimedes, I think he said, if you give me a lever long enough, I can move the world. Is this idea of like, okay, it's the balance of forces. And the idea being, if I can put the same input and get greater output, well, I'm going to pick that over fixed input to fixed output, which is a job, essentially, with marginal growth as you get promotions. And I understood it as, through Naval again, it was just, there's four means. I added the fifth, which is trading. But it's like, as you mentioned, brand, it's code, and now more so than ever. And then it's capital and labor. Now, not all of these are introductory. Not everyone fresh out of uni can have capital leverage or have labor leverage because it takes money.
Yeah.
But anyone can access a brand. Anyone now can use AI. Anyone can now at least access the markets through investing or through trading. So it's putting these means in young. So then at a point, as you were thinking about, when can I start to replace my income? And I just did a calculation. So for me to replace a dentist salary, I need 2 million in the bank with average returns and pulling out a certain amount to not affect inflation. 2 million is a huge number, yes, but it's also not a huge number in this day and age. I say that with a big asterisk to not come across any type of way, but you know, you see 16-year-olds in this day and age, 18-year-olds making $1 million online. So it's a new era.
It's getting around people who have that belief as well. Like your environment dictates performance, right? So when you've got a job, you're in a job, and having a job's normal, and everyone around you who in the job is normal. And if you see entrepreneurs, that's weird. When you get around entrepreneurs, everyone who has a job is weird, right?
You know, it's so weird. I mean, I feel like I'm in a very blessed position because of this show. Because I sit across people every single week who are all doing 100K a month, 500K a month.
Right.
I've met people doing $2-3 million a month at a young age. And the number one thing for me is that normalizes it. Number two is like when I speak to them, they're all normal. Like you would think someone who's making $1 million is like this super high IQ, super this and that. They're just regular people who chose a better vehicle,
more leverage,
more leverage in essence, which is why I think it's one of the most important things, and it can also apply to trading. So I'm going to bring it back. I feel the biggest form of leverage right now, I want to hear your take on it, is with prop firms,
right?
Because now with a $500 or $1,000, which is all that people have access to, really, young people. They can now have buying power of 100,000, and caveat, if you have the skill set, it can be life-changing. How do you approach this vehicle of wealth creation, which is prop firms?
So I've always been very skeptical of this new found prop firm approach. And the reason being is because I see a lot of them as wolf in sheep's clothing, where they come across as if they're there as the hero to help you as a trader. But in actual fact, they know the stats, and a lot of them have now manipulated the system against the trader because they're looking for the registration fee over the payouts. And I've done a recent study, and I've done a lot of investigation work into those, and I'm bombarded daily with people sending me messages of how they resist payouts and
It's true.
how they advertise themselves as a prop firm, but actually they're a tech company, and then they don't have to meet certain regulations because they're a tech company, is paying, and all this kind of stuff, right? Offshore accounts and all this kind of stuff, right? So my biggest red flag with them is I know some very reputable real prop firms who started a business with their own cash, and their only priority was to find the best traders in the world so that they could trust them with their hard-earned cash to then split the profits with them. Right, that is what a real prop firm is. It's like one of the most selfish business models in the world. But you get a group of great traders, and you cling on to them, and you give them nicknames so that no one else can poach them. Right, that's a real prop firm. And a real trader, a real approach to trading, understands that it's not time based. You never know how much you're going to make in any period of time. It's just profit over time. So to incentivize for the first incentive to be, you need to make X amount in 30 days. It says, it's so obvious to me that that's not in the best interest of long-term partnership with a trader, because I wouldn't put that on a trader if I was looking for one. I would be like, well, why would I want to put that pressure on them when I don't know when they're going to develop a profit? So I started spouting about that on YouTube, and all of a sudden I think a lot of them have dropped that 30-day thing, but now they've manipulated the payouts other ways.
So there is basically, the way to look at it is the business model relies on the downfall of traders. But the problem here is you either put the blame on the platforms, which is a fair thing to do. They hold a level of responsibility, but as does the individuals who have no right to trade, who are lining their pockets. So I think the weight is on both sides.
Of course.
and the way I look at it from a bird's eye view is like, it's just certain necessary evils. Now you can do the trip them up because of this, trip them up because of that, but the model itself is designed where the losers pay the winners. But when I do say that, I think, well, isn't that how brokers work? A B-book broker. And when you zoom out even more, you're like, well, isn't that how the market works? Where it's a closed loop.
Yeah.
Money is not created or destroyed. It just goes from one hand to the other. So morally, yes, there is an argument there. But in terms of logistics, I'm like, this is how everything operates. No matter your vehicle or platform, the market is a zero sum in essence.
Absolutely, I agree with you. But if I was to guide someone into one of these prop firms, I would just say, make sure that they don't have such an aggressive performance target in such a short space of time. Make sure that they are looking out for you as if they were going to employ you. Is it that approach? Are they asking those types of questions of you? And is there any resistance on payout? What are your requirements to get the payout smoothly? And from what I've seen, there's very few that have been nice experiences. But again, I don't know if that's the trader or the
the reality is even the biggest of prop firms have these allegations and things going on. But when I look at it on an individual basis of a trader who knows what he's doing, he might get a denial of a payout or some rule that messed him up that was a bit unfair, but they still make decent money. So let's say someone who made 100 grand in payouts, maybe they got denied or wrongfully robbed of 10k, but they still made that other 90k.
Right.
Which they wouldn't have otherwise, which is why it becomes a hot debate in the industry of like, should you, shouldn't you? But let's speak alternatives for someone who is newcomer to the industry. How can they access enough buying power, or not make 10% gain on a $1,000 deposit? Then you might as well just go get any old job. how do you make the effort worthwhile in the markets?
It's going to be a difficult thing to believe for someone who hasn't had their eyes open to it. But if you can prove to yourself after 6 months or 12 months that you can make a decent return, there is money out there to be thrown at you. I've just had a trader here who's had a meeting with a series of family offices. They want to chuck 15 million just to try him out. You know, so it's really a case of just proving to yourself that you can be consistently profitable, because no one else cares if you're going to crack this or not other than you. Trading is like the harshest thing. It's just a mirror of you. And if you can prove to yourself that you can generate a consistent return, there will be people willing to throw money at you. And I know that's hard to believe, but that might be a better route. If it is, you know, and if you want to go the prop firm route, chances are you're going to have a better deal. But as long as the focus is on you proving to yourself that you can do it, rather than trying to impress someone or change the way you are to kind of get lucky for a period of time, which isn't sustainable, then you've got a good shot. The money's there. Like, you'll have a newfound confidence as well to throw every penny into the account. So a lot of traders, they don't want to put as much money into their trading account because they don't believe in themselves. But when you believe in yourself, you're like, right, I've got to sell everything to chuck into here. Like, you get this kind of newfound confidence. And unfortunately, you have to prove to yourself that you can do it before you get to that point.
I wanna wrap up the episode on the topic of psychology. Now, this is a super broad word, but I want to hone it in around psychology of investing, psychology towards money in general, and psychology in trading. So, as we alluded to earlier, where there's certain childhood things that can ruminate in adulthood, I've also spoke to someone who interestingly put it. He was like, there was a study where if you were born or your financial formative years were during a recession versus a bull market, your attitude towards investing would be different, because it's what you know, what you expect, your tolerance to risk, how your parents' relationship has been to money. Where are they spenders or hoarders? Are they living beyond their means or under their means? All of these things have an influence. So when I say this thing, psychology, when it comes to investing, trading, and money management, I'll leave it broad and let you navigate. But what does that mean to you?
Absolutely. I mean, when I was a kid, I grew up on a council estate in South London, and every Friday, all of the parents used to kind of congregate at the foot of the steps of the block that we used to live in and just talk about the week and moan about money and all of that stuff. It was like, oh, bosses, why can't he give me, rich people are greedy, all this kind of stuff. And I was earwigging, I was a nosy little 13-year-old kid. But what I found fascinating is at 7:30, this guy called Roy used to come down and take everyone's money and go and do a syndicate lottery. And then for 10 minutes, their face would light up talking about money. It was like, if I won, I buy this and buy that. And I just remember thinking, this is weird. They've just moaned about money. Now they'd love it, right? And I remember thinking it was weird. What I learned later on is how they use it, and how you use it is really dictated by the language that you're using around money, the internal dialogue that you've got around money. So if you're saying that's a rip-off, that's if you're using that type of language, it will dictate your actions towards how you use money. And really, the key to growing wealth is about dancing with it. It's having not such a tight grip on it that you can't allow it in and out. It's about
then you're almost chasing it, or it's scarce to you.
Exactly.
As opposed to abundance. And
you need to be able to give and receive and let it flow. And that's why it's a currency, right? It's a current, and you need to let it flow. So if you've got negative mindset and negative beliefs around money, or you're using negative language around money, the language will dictate how you act towards it. And the irony is, you'll never attract any if you have people who say you might die tomorrow, are the ones who chase their entire lives working for money. They're slaves to money their entire lives. That's the irony.
I finally have a special offer to share with all of you from the US or my futures traders, which is over 20% of the listeners of the show. And that is Alpha Futures, a leading futures prop firm that is working with Trader 8 and Ninja Trader that are compliant with CME regulations. With the largest end of day balance drawdown in the industry, a 90% profit split and same day payout. And with the most competitive pricing in the industry, industry with accounts starting at just $79. On top of that, just by being a viewer of the show, you get up to 40% off all evaluations. So why not get started with an evaluation right away, trading $50,000, $100,000, and you already know the power of prop firms and larger capital. So go ahead and use the link in the description or code TOT for the best prices in the industry plus the best discounts in the industry to make this a home run offer if you are a futures trader.
This thing of like internal dialogue, it's the most underrated thing. Even when it happens more in the UK, I'll be honest, but when I say, how's it going to someone, they're like, oh, not bad.
Not bad.
It's like, why frame it not bad? Like, why not anything good like to come out of that? It's down to these things. Just a quick tangent, but my youngest brother, he had 3 older brothers who all did well at school, good grades and so forth, and he felt the pressure of like, I got to live up to this reputation. And he just found himself in a negative spiral of talking to himself, in the sense of he just had these friends in class, which everyone does, who don't study and get great grades. They're just naturally smart people. And he was like, I work this hard and I don't get the same grades as these, so I'm not intelligent. And he just started to believe this self-prophecy of, I'm not a smart person, I'm not going to get good grades. And it ended up really being an anchor on him. So when I recognized this pattern, I tried to correct him. Hey man, look, you might feel like this and that and the other, but the reality is your hard work, your effort leads to results. Yeah. And I tried to drill this into him and he ran with it. And I remember for GCSE, I studied maybe a month. He, bless him, started studying like 7 months out and 10 hours a day. He really ran with it. But on results day, he wanted to go alone to pick up the results of school. So nobody went with him. And it's 8 a.m. That he gets the result. And I get a FaceTime from him. I'm like, oh, he's calling me. This can't be good. I don't know. I just felt like, I felt nervous for him. And I answer the phone, I see his face, and he's just laughing. He just couldn't stop giggling. Like, what happened? He's like, I did it. And it was just this moment of relief that my hard work did pay off, and it did get the results. Amazing. And it wasn't this anchor of, I'm not as smart, or whatever he believed. And he just talked himself out of this negative speaking to be positively speaking. And fast forward to A-levels, he really ran with it even further. He was like, my efforts lead to my results. Yeah. So the world is my oyster. And I remember he was going to the gym before school, UK weather, 8 a.m., running to the gym in the rain, then running to school, and then, in the library, and set him on a great trajectory. But it all started with correcting that internal dialogue. And
amazing.
I think there's something we can all do better at, because it's really this limiting belief that we all have. And as we said earlier, of my perception of what is achievable is because of the people I speak to, and it becomes normalized. So therefore my path gets carved in that direction, such as environments. I guess as we are in Dubai and you leave Dubai tonight or tomorrow morning, let's speak about the topic of Dubai. So we spoke about it earlier of like, would you ever move here? What about taxation? And the reason I said that to you is because this financial freedom, I look at it as a rocket, and you have your fuel, which is your leverage means, your efforts, your resource, your intellect, everything that is going to be propelling you forward. But then you have the anchors, which is gravity, air resistance, all of these things as what is throttling you away from financial takeoff. Quick analogy. And one of the biggest resistances to wealth I see is taxation, which is a big reason why I moved out here. Your answer to that was, you couldn't care less, essentially. What is your views on taxation and living out in an environment like Dubai, where you have an environment where people are growth orientated, tax is not going to be a burden on you? Why do you still choose to be in the UK?
Yeah. So taxation and inflation, those are the two kind of cancers of wealth building. Inflation being the hidden one, and tax being a bit more, obvious. And you change things when the pain of something becomes worth changing for, right? So I could get overweight, and at some point I could get really overweight where I'm going to decide to go running every day. But until that point where I cross the threshold of it being unbearable pain, I won't. And for me, there isn't enough advantage here for me to want to pay less tax than being settled in my life at home. As I say, I'd live my life every day for the rest of my life. I'd be very, very happy. Having said that, I'm 43. If I was 20 years ago, this would have been a phenomenal place for me as an entrepreneur to come and make connections. I probably would have tripled the speed at which I could have achieved what I've achieved just from the connections I've seen this weekend. Has been just unreal how it works here, like unbelievable. So fast. Everyone is here to open. We're on this podcast.
About an hour ago.
It's exactly that, right? So it's unreal. And yes, taxation and all that kind of great stuff. And I've got many friends starting businesses here. For me, I've got a family, I'm settled, and I would rather pay tax at the moment that is the payment that I'm making for my lifestyle at home.
Choose, yes.
Exactly that. Yeah. So, who knows? Might move here in the future. But
who knows? Yeah, the last thing I want to say is this inflation idea, because I only got my head around it through ChatGPT, I'll be honest. ChatGPT is raising me these days. But I tried to understand, why is inflation so bad? Or what is the catch-22 of it? And is that inflation only affects the poor. And what it means by that is your salary gets eroded away by inflation and things cost you more because of inflation. But a wealthy person who owns the assets, they get asset appreciation because of inflation and debt erosion because of inflation. So the rich benefits from inflation, the poor don't. And that's kind of a very apparent wealth divide and a kind of a fault in the economic system, but crazy as such. Thank you very much for coming on the show. This was very spontaneous. I think we touched on a wide selection of topics, but thank you very much.
I've really enjoyed it. Great stuff.
Epic.
Thank you.
There we go. Boom. Well, man.